Index funds versus ETF. What is the difference between the two and which is better for an investor? Come, let's do a detailed analysis in this video. In US mutual fund industry, ETF has been a popular investment product. The predominant reason for this is index fund is listed as ETF before buying or selling it, and the expense ratio will be lesser than the normal index fund. In India, index funds is a replica of ETF. So there is no much of a difference between investing in ETF or index funds. The same index is available as an index fund and as well as a ETF. Say for example, Nifty 50 is available as a ETF and also as an index fund. So where should you invest? Whereas in index funds it is not the case. It is similar to buying mutual funds, where you buy mutual funds from a mutual fund company and give it to the same company for repurchase. When you are investing in ETF, it will be traded in the market and there is a chance of intraday volatility. When you are investing in index funds, there is only one NAV daily. You will buy or sell at the end of the day NAV like other mutual fund schemes. You should analyze the impact cost in ETF. What is impact cost? The actual NAV value and the trading price in the market might be different. The reason being that the buyer and the seller are not equal and there is a mismatch over there. As there is no match between the supply and demand, the value of it might be 10 rupees but it can be sold to 15 rupees. The value of it may be 20 rupees but when we are buying it, it can be 25. So there is a lot of chance for this mispricing in ETF. Especially in a bearish market, investors may be forced to sell at a discounted price compared to its actual NAV. In ETF investment, there is also a problem of no buyer situation. Suppose if you have an ETF investment and you are looking to sell it, there can be a situation where there is nobody to buy it. Whereas in index funds, if you are looking to redeem your investments, you will go straight to the respective mutual fund company and you will redeem it and they will credit it for you. So there is a less chance of no buyer situation or liquidity problem here. The unique sales proposition of ETF is that it has low expense ratio compared to index funds. Maybe it looks real from the outside, but if you consider the overall cost, it might be on the higher side because expense ratio is included in index funds and there is no additional cost. Whereas in ETF, there is an inbuilt expense ratio. On top of it, when you sell or buy it, in your demat account or broking account, there are broking charges. Then there is a demat account maintenance charge as well. The fourth one is the impact cost. You might have purchased it in higher price, but when you are selling it, you might be forced to sell it at a lower price. This is because of impact cost. So due to all these factors, index funds are more friendly compared to ETF. So far we have covered about ETF and index funds in detail. I have also explained to you which is a better option. Now the next question is, which is better between index funds and active funds? When we take the case of India, actively managed funds possess a lot of growth potential. The reason being India is not a matured or developed market. Here sentiments overrule us and that is the reason why actively managed funds are able to generate more returns compared to index funds. Based on this topic, we have published blog posts and videos before. I will also provide the link with you. When you are looking to invest in India, ETF is better than index funds and active funds are better than index funds. If you don't know how to choose active funds, then you can take the help of professional mutual fund distributor or a financial planner. If you don't have a trustworthy financial planner or a mutual fund distributor, in that case you can limit your investments to index funds. But if you know how to choose actively managed fund or you have the guidance of a professional financial planner, then you can invest in active funds without worry. The reason being that active funds expense ratio of 2% is nothing. They will generate more alpha than the 2%. We should understand that in mutual funds, the NAV is only after expenses NAV. When you are seeing the NAV to NAV returns, you don't have to take into account the expense ratio. I think many investors are obsessed with expense ratio and that is the reason they invest in index funds. By focusing too much on 2% expense ratio, they are missing out on an opportunity to generate additional 5 to 6% alpha. If you have any doubts regarding ETF, index funds and active funds, Please mention it in the comment section. I will meet you again with another interesting video. Thank you. Are you in search of a personal guide who can remove the stress of handling your finances? Then please feel free to avail our expert consultation. And also you can attend our webinars to gain investment related insights. Both the consultation and webinar are absolutely free and you can find the link in the below description. Please like and share and do subscribe to Holistic Investment.